Hi, everyone. Can you hear me? Okay. Can everybody hear me? Is everybody here now? Okay, great. Okay. Quick background before we start. This is about operating agreements. And just a quick story before we start. There was a great rabbi. When he was 5 years old, he had just finished learning the Jewish alphabet, the Aleph Bet, and he was very happy with himself. And he used to stop by his grandma's house every day on the way home from school. And he comes into his grandma's house. He's 5 years old. He says, "Grandma, I know the whole Talmud." Now, Talmud is like the encyclopedia of Jewish law. It's behind me. It's like a whole bunch of volumes, like 30 volumes, and it's very complex. It's not even in Hebrew. It's in Aramaic. And his grandma says, "Really? You know the whole Talmud? That's great. How did you manage that? You're 5 years old and you just learned, you don't even know how to read. You just learned the alphabet." So he says to her, he says, "I'll tell you what, take out any volume, show me any letter, and let's see if I know that letter." So she understood his cute joke. He obviously didn't know any Talmud, but he knew how to read every single letter in the Talmud. Our webinar today is going to be quite the opposite. We're not going to learn how to write operating agreements. We're not going to read operating agreements. What we're going to understand is what they're all about, what's inside of them, and some of the key features that you should be looking out for and why they're so important. So I'd like to share my screen with you, and let's jump into the presentation. Now, quick question. Okay, let's see. We have the screen here. Okay, great. So you can all see my screen now. So what the title of this webinar is called Creating Forbes, Not Frankenstein. When we build a company, one of the first things we do is we set down the bylaws, guidelines, the Bible, whatever you want to call it. And that's how the company operates according to those laws. So the idea is to make us wealthy, to make our operation a success, to make our company a success, and not to complicate things. And there are a lot of things that people don't think about before they start that happen down the road that can complicate a company. And therefore, we try to cover all this stuff in the operating agreement to sort it out. So when something does arise, we have all the answers and we know where to look. But it's always better to look before to understand what you're getting into. And this way you can negotiate and make sure that it's written suited, depending on who you are, in your favor. Now, quick question. If anybody knows, anybody has a guess, how many pages do you think operating agreements range from lowest to highest? Well, what do you think our normal operating agreements. So you can have an operating agreement that's 1 page, and you have operating agreements that are 100+ pages. That, I think, shows you the flexibility of the operating agreement and how it's not structured in any way, shape, or form. It's up to you. You write the code for your LLC. In this case, you're going to write the code and decide how it's going to run. You could write a lot of instructions, or you could be very brief and write very few instructions. So often people will just get a 1-page template or 2-page template. But when you're talking about serious deals and complex companies, you're talking about 100+ pages. Before we start, there's the disclaimer. This is just, I don't know how entertaining it is, but it's for entertainment purposes nevertheless. I'm not a lawyer. I am not an accountant, although I have an degree, but I am not your lawyer. I'm not your accountant, and I don't practice today. So just take all this information and do your own homework when we're done if you see anything that's interesting or something that's relevant. So our agenda today is going to consist of 2 parts. The first part is we're going to dive into key sections of the operating agreement and discuss them and what some of the options are. And the second part is going to be more practical. We're going to take a real estate deal and the different players and discuss a little bit what exactly they want to see in an operating agreement. Okay, I don't want to take up too much of your time, so we're really not going to, we will highlight a lot of the details, but we're not going to dive into them. We're going to try to go through this as quick as possible. I have no idea how long it's going to take. I know you're supposed to look in a mirror and practice before you start, but I've never done that. I don't have any mirrors here. So I'm going to try to be as brief as possible. I think even if we're brief and fast, we will cover a lot of interesting points that may be helpful to you. And if you have any questions at the end, you can always ask me or contact me in a different way. So here are the basic operating agreement sections. And the ones that are bold are the ones that we're going to look a little bit more deeply into today. So we're going to start with the purpose and scope. Every operating agreement for an LLC starts and it says what the purpose of the operating agreement is. Now, you got lots of choices over here. A lot of times we'll say that the LLC is meant to perform any legal activity in the state that it's formed in, and sometimes it has a specific purpose. Now, when you are in a real estate business, you can have different types of real estate activities. You can invest, you can be a developer, a manager, flip, or a syndicate. You can have a geographic focus and say that we'll be investing only in a specific area. It can have a duration of the investments, and LLC can say that this LLC, again, the operating agreement breathes life into the LLC, and it can limit the time of the LLC. It can say that this operating agreement gives life to the LLC of 5 years, 10 years, whatever it is that you want it to be. You can say that it has an environmental or social purpose. That's a very popular way of investing today, whether it's affordable housing or environmental housing. And you can say specifically that the LLC is built to invest in joint ventures and partnerships, just so everybody understands what your company is going to do and they don't think that you're going at it alone. Now, when you open up your own LLC, typically want to be possible. But if you are, let's say, an investor and going into a deal, you want to make sure that it's very specific. That what they told you you're giving your money for is what you're giving your money for. So you just want to make sure that they don't leave themselves the room to say, well, the operating agreement says we can do anything. It's true, we discussed going into a multifamily housing, but we decided that we are now developers and we want to take all your money and develop with it. So you just want to make sure that it's specific and it says exactly what you're going to do, and there's no wiggle room for anything else. And not only that, if they do things outside of the scope of the operating agreement, so then there's something you can do about it. But if it's very general, then a lot of people call me up and say, can I do X, Y, and Z? And I'll look at the operating agreement and say, sure, you could, because there's no specific purpose over here. So theoretically, the operating agreement allows you to do that. And again, you want to have exit strategies. If you're investing, you don't want the money to be tied up indefinitely. You want to know that it's going to end at some point and you will get your money back. Okay, it's very important to know one of the key features of the operating agreement is who controls. The operating agreement is going to tell us who controls the LLC. That's done through the section on management structure. So there are various different management structures that we have. you can have a member managed versus a manager managed. That means that either all the members, if it's member managed, that means that all the members are equal managers in the LLC and they all have an equal say. Nothing could be done without all of them. Versus manager managed, where the LLC or the operating agreement appoints a specific individual and that person becomes the manager. And there's also different combinations. You can have members plus a manager, or you can divide it where the manager decides certain things and members decide other things, which we'll get more into as we go along. So the roles and responsibilities of the manager, whether it's the members or a specific manager, is you can have general authority. That could be hiring, firing, taking care of the books, running the operations. Now, you do want to write if you're going to be delegating, if the manager is going to be delegating authority, if the operating agreement gives him, the manager, permission to do certain things, it should say the things that he'll be delegating, that he has authority to delegate these tasks to someone else. And there are limitations on authority. So, for example, it can say that the manager has authority to do or take out loans or do any transaction up to a certain money limit, like $10,000 or something like that. And we'll get into more things that are a different class of decisions rather than just basic day-to-day. When there's member managed decisions, so you have to decide how do members decide on how the path forward. It can be with a simple majority, it can be a supermajority, or it can be unanimous consent. So again, that can be split depending on what the type of decision is. If a simple majority is going to be enough, or you want every single person on board in order to agree to take that path. And you also want to have deadlock provisions. Let's say you have, it's 50-50 and you can't figure out what to do. So you can have maybe a third party or one person that gets the deadlock vote. So what are some of the major decisions that we may or may not leave to the manager or may get the members involved? That could be selling or acquiring property. It could be if you want to incur significant debt or liabilities, not just a small loan, but if you want to refinance or you want to take out a mortgage or something like that, that's something that members may have to sign off on. If you want to amend the operating agreement, clearly the members would want to agree to that and not let just somebody, this is what they're counting on. This is the bedrock of the LLC. And if you're going to change that, everybody should agree. If you're going to admit new members or you want to liquidate the LLC, these are all crucial decisions that aren't part of regular managerial responsibilities in most operating agreements. So that's something you want to just highlight and make sure is highlighted in the operating agreement that the manager cannot do or whatever is agreed upon by all the people of the LLC. Now, there are other factors that are very crucial in management structure. One is the managerial term and succession planning. You may not want to make somebody manager indefinitely. You may give that person a 1-year term or a 5-year term, and then you want to figure out how exactly the operating agreement should highlight how the next manager is going to be chosen. Is it going to be by unanimous consent of all the members, a majority, supermajority, whatever it is, you want to make sure that the succession plan is there. So when you get to that crossroad, it doesn't become a problem. And this is also very crucial. You want to have an option to remove or replace the manager. Now that can be with cause, without cause. It can be with a certain amount of, members that agree or don't agree. Whatever it is, there should be an ability to remove the manager in case things don't go as planned. Okay, so how are we going to protect the investors? That's also a very essential part of the operating agreement, to make sure that the LPs, when they get into the deal, that they have their rights protected. So that section is called a membership interest, and there's different type of membership interests. You can have different classes of members, which again, we'll get into more as we break down what the typical LLC looks like. You can have economic rights versus voting rights. So if you have, let's say, two classes, Class A and Class B, they can have the same economic rights, but because Class A are the managers, they'll have more voting rights than the rest of the members. And if you have members that are active, then it should state exactly what your compensation is if there is going to be compensation for them. When it comes to voting rights, the question is, how do you give out voting rights? It could be either proportional to the amount of equity you have in the LLC. It also could depend on what kind of majority you're looking for. And again, you should have deadlock provisions in case things get tied up. Now, for minority protection, so, again, that's always the fair. When there's a majority, they can do whatever they want, and the minority can be treated unfairly. So first of all, a lot of times you'll have access to information. Just because you're a minority, it doesn't mean that you don't have access to the information. Every single person should have access to certain information about the LLC. And there should be exit options, because if the minority is not happy with the way it's going, there should be a way for them to get out. You probably don't want them on board. They'll make so much trouble and so much noise. And they certainly should not be held hostage within the LLC if they're really not happy with the way things are going. And then another way to do it is to create supermajorities for certain decisions. So once you have a supermajority, and that could be 90%, 80%, 75%, whatever it is that everybody agrees to, which will mean that you're not having a 51% majority controlling the whole LLC. And, when you get to 90% or 75%, so the minority will just have to go along with it. Now, when it comes to admissions of new members, you want to figure out the approval process. Now, LLCs, depending how big it is and what type of deal it is, but they could be closely held LLCs, and you may not want new people who you're not familiar with, who may be friendly with some of the members, maybe have business ties with them, and you're not comfortable having them in. So you need the operating agreement has to figure out a way how you approve new members. It could be with the manager approves them. It could be a majority approves them. It could be you need unanimous consent. But whatever it is, it should be written in the operating agreement, because at some point you may need new members, and you don't want this to hold up the whole LLC. And, a lot of times the biggest problem with LLCs is they get stuck in court, and that's how they fail, because of fights with things like this. And everybody wants to admit or not admit. And while business is fine, but these things get in the way and they cause an LLC to fail. So this is certainly something that needs to be written, how you're going to approve new members. You want to figure out what the initial contribution of every new member is, depending on the fair market value at the time or some other metric, and the dilution. So sometimes you'll have to admit new members because you don't have enough money, which obviously may not have been the plan. So sometimes you may say that the managers would have to dilute more of their share than the limited partners, because they're the ones that caused the shortfall in money because of their poor management, and therefore the investors should not suffer dilution because of the fact that we need to bring new members in. When a member wants to withdraw, that should also be addressed in the membership interest section. There should be notice and the final requirements, how he gets paid out, what he does if he gets paid out, what the impact is on the remaining members. And then there's also involuntary withdrawal and expulsions. So if somebody goes into bankruptcy, or somebody does something against the company and he gets thrown out, or there's a court order, so there may be penalties. He may lose his shares. They may just be soaked up by everybody else. All these things should be written in. Now, members' duties. Members have two basic duties: to non-compete, and we didn't get the other one. Not to compete with the company in many cases, and also confidentiality. They shouldn't be divulging the secrets of the LLC. The next big section is contributions. Every LLC needs money, and the question is, how are we going to get money into the LLC? So the first thing is initial contributions. When you start an LLC, you create the members and everybody puts money in. So the question is, do they put fixed contribution amounts where everybody puts the same amount of money? Or is it percentage-based contributions where certain people own a larger percentage of the LLC and certain people less, and based on that, they put their money in? Or there's some people that could get shares of the LLC without putting any money in. It could be either they could have assets they contribute, they can contribute property or other assets, or they agree to give service to the LLC. Okay, sorry, I thought we had a... Okay, what happens when the LLC needs more money? What do you do then? So you need additional capital contributions. This is every investor's nightmare, called the old capital call. And you don't want to hear from the managers that they're out of money, something went wrong, and they need more money. So the operating agreement should address this. It could state that there would be mandatory additional contributions when needed. There could be voluntary contributions, which means if money is needed, then members can put in equity, or they can actually loan money to the LLC. And then you would have to decide how those loans are paid out, what interest rate, and all this should be written into the operating agreement. And whether they're equal or proportional contributions. What happens if there's a capital call and the operating agreement says that that's valid, they can do that, and somebody doesn't contribute? So what you can either dilute his ownership, or if the money's needed, one of the members can actually loan the LLC money, and it would be you can force the member who didn't pay to pay back that loan with interest. And there could be penalties or fine. If somebody doesn't answer to a capital call, the operating agreement could state, for example, that they would lose their voting rights because they're no longer an upstanding member of the LLC. If there are loans from members, then either they can stay as loans and you can decide the terms. They can be convertible debt, which means that the operating agreement could give an option to convert it into equity at some point down the line. Or you can have third-party funding, where you get funding for issuance of additional membership interests. Again, all this should be in the operating agreement, what to do. These are all scenarios, and the best operating agreement doesn't have to be 100 pages, but there are basics that it has to cover, and obviously funding is a very crucial part. It shouldn't be something that you think about as you go along. It should be from the onset, you know how much you're putting in. Those are the 3 pillars over here, how much everybody's putting in, what other members would have to put in, and what you do when you have to seek outside financing. So now the fun part comes, splitting the loot, right? The company makes money, either it has cash flow that it wants to distribute, or there was some event that you sold the property or something big. So how do we do that? How does the operating agreement deal with that? So you can distribute either pro rata, which means strictly based on the percentage, and that would typically be for a member managed LLC, where everybody are equal partners. Or you can have a varying ownership class split, where again, if you have passive investors and active investors, the active investors are clearly going to get a larger piece of the profits, even though they put less money in. And you do that again by doing different classes of investors, classes of stock in the classes of membership in the operating agreement. You can also have a preferred return. We'll get to this a little bit later, but there's a capital stack. It's not just limited partners and general partners. There are a lot more people involved in every LLC, and some of them may get a preferred return before the other ones do. And then you have the waterfall distribution, which means that based on where you are in the capital stack, you get your money back first, and then the next people go in the next layer, and it goes to different layers, which again, we'll touch on a little bit later. And another thing is that, like a lot of operating agreements will say, before anybody gets from the profits, the first thing we have to do is return everybody's capital. So the first distributions will be based on amounts where we fill people up until the point where they have their entire capital out of their initial capital out of the deal. And then we can start returning profits beyond that. What are the timing of the distributions? So they can be quarterly, annually, or they can be ad hoc distributions. So again, it will depend on what type of deal you're in. If you're talking about a multifamily that's actually cash flow, and that's why people came into the deal, so you're going to get probably quarterly or annual distributions, because that's what it's all about, getting those annual checks. Or you can have ad hoc distributions, and that would be more for a deal where the money and the reason why people are coming in is for the appreciation. So when you sell, or if there happens to be more money lying around, then you can distribute that as it's available without committing to any specific distributions. And that's, you can also distribute after a refinance. That's a very popular practice. Once the property goes up in price and it's worth that much more, so you can refinance the mortgage, and then you can pull out all the investors' money, pay them out, and then the rest is all profit. What about withholding distributions? So one reason to withhold distributions, not every time you make money, you give it out, right? You need to keep some for the operating expenses or future liabilities. You want to keep a fund for anything you might need in the future. Or if you want to reinvest. And again, depending on the structure and the nature of the LLC, there may be a reinvestment, depending on what the purpose of the LLC was, or this is a one property deal and there's no reinvestment, so that wouldn't be relevant for LLC like that. Now, there's also tax distribution provisions. The way taxes work in an LLC is if the LLC made money in a tax year, then you would have to pay taxes on it, whether they distributed the money or not. So if your account is credited with a $100,000 profit, you would have to pay, let's say, 30% on that, whatever, just random number. $30,000 you would have to pay. So let's say the managers decide there's no distribution. That means I invested money into the company, and now I'm out of pocket at the end of the year, $30,000. That's not something that most people are going to agree to. So what they'll have in the operating agreement is that at the minimum, there needs to be a distribution for everybody to cover their taxes, so they don't get hit with a loss from their LLC. Now, another type of distribution can be in-kind distributions, where they don't necessarily give out money, but they can distribute some of the assets. They can distribute a piece of land. They can distribute some of the machinery, whatever it is. That's another type of distribution that can be addressed by the operating agreement. And then another interesting tax issue with LLCs is you can have loss allocation. So you can actually have profit allocation as well, profit and loss allocation. So what that means is that you don't necessarily have to give it out pro rata. Let's say you have one investor that has a big, he made a lot of money this year and he needs some tax losses. Well, other investors don't need any tax losses. So you can allocate the losses to that investor in order for him to wipe out his tax debt. The only problem with that is that the IRS is going to ask if there's any specific reason why you did that other than to avoid taxes. So if you can't come up with a legitimate reason why you allocated one person more losses than their share, then the IRS would have a problem with that and they would challenge it. But there are ways to make it work and to allocate losses and profits as needed. So for example, if somebody's in a higher tax bracket, they may not want the profits that year. You can give it to someone else and give it to somebody else a different year. But again, all this has to be justified. It doesn't have to be a really great reason, but it has to have a reason. Okay, saying goodbye. What happens when not all the members are staying in the LLC? So that's addressed by the section called transfer of membership interests. Somebody may want to sell his share, may want to gift his share. What do you do about that? Because again, as we said, not everybody, when you go into an LLC, you know who the members are, and you don't necessarily want to find yourself in bed with people that you don't know or you're not comfortable with. So there are restrictions on transfers in the operating agreement. There can be full restrictions, which means you simply cannot transfer your shares to anybody, period, without approval. There can be partial restrictions, which would say something like, okay, the economic interest, if you want to give out your distributions to somebody else, you're more than welcome to do that. But that person is not a member in the sense that they won't have any voting rights in this LLC. And then there's option, if that's what makes sense for all the people in the LLC, all the members, you can have a free transfer where you're welcome to freely transfer your shares to whoever you like, do whatever you want with them. You can also have a clause for a right of first refusal. So if somebody does want to sell their shares, the other members can have a right of first refusal, and they can buy them and match the offer of any purchaser. But that could also have time limits. So for example, somebody says they want to sell their shares, you can give a 30-day time limit for the right of first refusal. And if nobody wants to buy it within the LLC from the other members, then you're free to sell it outside to other people. So what kind of consent? We said if there's partial restrictions or full restrictions, obviously you're not restricted. You're restricted without the consent of the people in the LLC. So you can have the operating agreement could say that the manager can approve any transfer the manager sees fit. You could have member approval, which would either be a majority or a supermajority, or you could have unanimous consent, and that's the only way that you would be able to transfer your shares. Now, there are certain permitted transfers, and these are things that should be written in the LLC, so there isn't any bad blood when you want to do it. If you want to give it to a family member, that is usually permitted. If you want to put it into a trust or estate, so you're pretty young and you're just making money and you got a lot of holdings, and somebody sits down with you and says, you know, it's time for a trust or some estate planning, and that means deeding over all your holdings to a trust. So, you know, officially you may not be able to do it because there's full restrictions on transfers, but there will be permitted transfers, which means you can't put it into a trust. And another typically permitted transfer is an affiliate company. If it's another company that you control or own, then you can usually put it in that company's name. So the question is, if you are selling your shares or withdrawing, which we'll see, what's the valuation method? How do you decide how much it's worth? So again, we turn to the operating agreement, and that's something that you would consider while writing it. How do you want to do it? Either you can have some agreed valuation metric. It can be, you know, cap rate with NOI. It can be fair market value, or it can be a discounted valuation, because, you know, even if the fair market value of the property is $10 million and you own 10%, which gives you $1 million, but not everybody wants to buy into the LLC. So if you're going to do a right of first refusal and you want to sell it, then, you know, they could say, look, we're only going to pay you $900,000 because it's not so easy to sell. So if we're buying it, we want a discount. You want to make sure that there's death or incapacity. We think it can never happen to us, but it happens to lots of people and lots of LLCs. And then what do you do with the person's shares? So either the operating agreement could call for an automatic buyout, or it can call for a transfer to the heirs. And again, what happens if there's an involuntary transfer? That would be, let's say somebody goes bankrupt or divorced, and suddenly this person's assets are all tied up in bankruptcy court or divorce court. So you want to have provisions that won't affect the way the LLC is run, because let's say you have the bankruptcy court is now your new partner in the LLC. That's going to make things very, very complicated. So when there is a situation like that, the operating agreement will usually call for a case that either they can lose their shares, or somebody else from the LLC can buy them out, and this way you avoid all the problems. They can also be a triggering event, or, you know, that could be anything, any specific event that you want in order to force an involuntary transfer. It could be if the person got into legal trouble and the courts are getting involved. So you would want to call an involuntary transfer. Now, there's also drag-along rights. Drag-along rights mean, let's say you have the managers or the people that really control the entity, they own 80%. And they decide that they want to sell the company, right? They want to sell their shares. So they're going to sell, they can't sell 80% because the buyers want the whole LLC, or they don't want anything. So what they can do is you can write in that if the majority or supermajority of the people are selling the shares to a certain company, then the minority would be forced to sell together with them. They don't have a choice, and they can force everybody to sell. And on the flip side of that is the tag-along rights. Let's say they actually do have a buyer for 80%, but this is not what the minority shareholders, investors bargained for. They knew that they were with this operating group. They don't want to be with the next group. So they can have tag-along rights, which means that if you're going to sell your 80%, you can only do it if you sell our shares together with it. But if you don't, then the sale is going to be invalidated. And then there's preemptive rights. Okay, what happens when it's time to wrap it up? You made your money, they'd appreciate it, everybody took their cash flow, and they want to move on to the next deal. They want to sell the property. So you want to liquidate the LLC. So you need to do a dissolution, and then you need to liquidate. You need to dissolve the LLC, or first actually liquidate the LLC, get rid of all the assets in it, tie up all your business, and then dissolve the LLC. So you want to write, well, that's the question. What forces a liquidation? So it could be a voluntary dissolution where everybody gets together and decides that it's time to dissolve the LLC, or it can be an involuntary dissolution, or it can be something that the operating agreement called for. Let's say you sell the main property and for some reason the managers are not ready to distribute all the money. They want to think about it. Maybe they want to go into something else and they're holding you up. So you can have a triggering event that says once you sell the main property or anything else, any triggering event, if the main manager leaves or something like that, you can call for a liquidation and then they would be forced to liquidate. So now you have to appoint a liquidator. That can be, again, you can decide who the liquidator is going to be. It can be the manager. It can be a third party. The operating agreement could call for a third party to liquidate the company so nobody has any bias in how they do it. Or it can be a committee of members from the LLC itself. How does the process look? You would wind up the affairs. You would sell or distribute all the assets that are left, and then you would maintain continuity. Now, what's the order of the payments? Now you sold everything and you have all this money and you have to give it out. How does it work? So the first thing you would do is give it to the secured creditors. First, the bank gets their money, and if there's anything left, you move to the next level. That would be the unsecured creditors. After that, you would go to the creditors who are members, the members' loans. After that, you would go to the capital contributions, and that's the investment. Everybody would get the investment back. And then at the end, whatever money's left, then you would have the final profit distribution. Now, again, we read this and we say, this is how it works. This is not how it works. This is how it often works. This is how it makes sense. And most operating agreements are written. But again, this operating agreement is yours. You can write whatever you want as long as everybody agrees. And then you could have a distribution waterfall with the profits. They can be distributed unequally, with people getting before others, depending on what type of investor they are. Now, even after you liquidate, you want to keep contingency reserves in case a lawsuit comes up or something comes up in the future. You may want to hold it for a year or two. And then after you have your contingency reserves, all the money is distributed except for that money that's being kept for any possible future problems. You terminate the LLC, which means you go to the state and you dissolve the LLC. Okay, those are all the sections of the LLC that we're going to talk about today. But there's one thing that I do want to discuss is the single member trap. You have single member LLCs and people form their own LLC and they think, okay, so now I have liability protection and asset protection and everything's great, but they don't really understand what the LLC is and they're not operating like an LLC. So the first thing is you need to make sure that when you have a single member LLC that you put certain things in your operating agreement to show that you're actually operating it as an LLC, because the whole point of an LLC is that it's not you. There's me and then there's the LLC. So the operating agreement would have to reflect that you can't do whatever you want. And there's rules to the LLC, even though you're the boss and you're calling all the shots, but there still has to be rules and the rules have to be abided by. So the first thing it should say in the LLC, make sure it says that there's a limitation of liability, because you have to say that this is an LLC and I'm not going to be liable for it. Even though it sounds funny, but you're going to have to decide who's the decision maker, who has management responsibility. So you can say it's the member, which is you, or you can say it's the manager. Now, when you do write an LLC, a single member LLC operating agreement, you do want to keep in mind that you may not stay single member forever. So even if you're the only one now, you may not say it should be member managed. You may decide that it should be manager managed, naming yourself as the forever manager, because if you say member managed, that means any member that comes in will be managers the same way you are. But of course, anybody who does come in will negotiate how he wants the operating agreement to look, and you would have to amend it anyway. But nevertheless, because if you want a real LLC, it needs a manager, and you have to play by the rules. You have the business purpose and scope. Now, you can say any lawful business, but obviously it's better if you're doing something specific to write it, because this will show that the entity is not you. Very important to have banking and financial separation. If you're going to run the LLC out of your own account, then chances are when you get to court, somebody sues you, you will not have any liability protection, because if you are commingling funds and using your own bank account, then the court will decide that it's not a real LLC and therefore you are liable personally liable, your home, your car, your yacht, everything else, not just the assets in the LLC. Capital contributions. It's very important to capitalize your LLC. Even if you have a separate bank account, you can't just like put in $10 every time you need to buy a notepad. If it's a serious entity, the entity needs money, and you have to put in a fair amount of money to run your business and to start your business. Because again, if you don't, then it's not a real LLC and you'll have problems with liability. You want to put in there that that the member is indemnified if anything happens, which means that the LLC will pay for all your court cases or anything that goes wrong. And very important, people forget this, to sign, and this is something I see on, I don't know, I would say 50% of the real estate contracts, people sign in their own name as opposed to the LLC's name. If you have an LLC, you cannot sign a contract in your own name. You have to sign by the name of your LLC, and then it would say by your name and manager or whatever authority gives you the right to sign that contract. Never sign it in your own name, because that's, again, that will be used against you in court. And it should also say how you dissolve the entity and wind it up, because again, you don't just, doesn't dissolve, doesn't merge into you, because if it does, then it is you. It should have a process for the dissolution and the wind up. Okay, part 2. We're going to go through some of the players in a typical real estate deal and see the key things that they want to see in an operating agreement for them to join the venture. So the first thing, obviously, are the general partners versus the limited partners, and there's friction there on how the LLC is going to be written. So let's see what each one of them wants. The general partners want control and decision making. They want to know that they control everything. They're the decision makers, and nobody has any say for nothing. They don't want to give anybody any say. Now, a lot of times that makes sense, because once you become a decision maker, then you may have a limited partner is not liable beyond their investment. But if they're part of the decision making, then they can be liable beyond their investment. So there are times that the limited partners may decide, yeah, we want to be totally passive. We don't want to have any say in anything. But there are times that the limited partners, there are plenty of things that we'll see that they want to have a say in, and therefore they would push back on this unlimited control. Management fees. The general partners want fees for everything under the sun, and we'll go through the laundry list in a minute. And they want to promote or carried interest. So even if they're putting in 10% of the initial capital, they're going to want 30 to 50% of the profit. And it doesn't have to be right away together with you. It can be after, but whatever it is, they're going to want to promote, which is far more than their equity share in the LLC. And they're also going to want indemnification, which means, well, they would like indemnification, meaning that if they are sued, whether it's for cause or not for cause, for negligence or not negligence, they'd like to know that they will be indemnified by the LLC. But obviously, they're not usually going to get away with that, and they're only going to be indemnified most of the time if they didn't do anything with gross negligence. So what are some of the fees that the GPs want? The first thing they want is acquisition fee. When they buy a property, they want 2 to 3% of the price of the property for all the work they did in finding the property and getting the deal done. They're going to want an asset management fee. For whatever the total amount of assets or money in the LLC, they're going to want 1 to 2% a year for running the business. If they develop a property and there's construction, they're going to want 5% of the cost of the construction as their construction management fee. When they sell the property, again, that's work. They got to find a buyer, work with brokers, get the deal done, negotiate it. They're going to want 1 to 2% of the price, the sale price. When they finance, when they get a mortgage or they get a bank or any finance or even a refinance, they're going to want either 0.5% or 1% of the total loan for their work. And then sometimes somebody will have to have a personal guarantee, and therefore on the bank loan or any loan. And for that, that person is going to want also 0.5% to 1% of the amount that they're guaranteeing. So all these are negotiable, and depending on how experienced and what type of group you're working with, they can be higher than this, they can be this, or sometimes some of these fees will be waived. Now, again, sometimes they could be capped based on the fact that we didn't make any money. So if the fees are going to be, once we get done with the fees, there's no profit left when they promised a certain amount of profit, then you can put into the operating agreement that the fees are conditional on crossing certain thresholds of profit. And then, of course, they promote or the carried interest, which is usually 20 to 30%. Limited partners, what do they want? So a limited partner is going to want a preferred return. They're going to want the investor group, the GPs, to guarantee them, let's say, typically 8% a year. And if they don't get their 8% a year, then it's going to be carried forward very often with interest. So next year, you're going to have to pay the first year with 8% plus interest, and then on top of that, another 8%. They're going to want their capital, a capital return priority, which means that before profits are distributed, they're going to want their initial capital returned and then worry about the profits beyond that. They are going to want, as we said, voting rights on major decisions. If there's going to be a loan or a sale or something like that, or changing the manager or anything really big, they're going to want to have voting rights, whether it's a supermajority, unanimous, or a regular majority. They're going to want to have a say in that. They're going to want to have limits on capital calls. They don't want to be called every 2 weeks. We ran out of money again. We need more money. And if you don't, you're going to lose your voting rights. So there's going to have to be so they're going to try to impose certain limits on what the capital calls can be. And they're going to want to know an exit strategy and liquidity. So if you tell them it's a 5-year hold, they may say, look, after 6 years, you're going to have to buy us out, or we're going to be able to sell the shares, or whatever it is, because that was the deal. So they're going to want to know that there's an exit and they're not held up forever. And the biggest point of contention for some reason, and it shouldn't be if it's a well-run LLC with honest people, is transparency and reporting. The fights are how often to report, which the general partners don't like to report because they don't like to spend their time busy with reports. And what kind of reports, what kind of detailed information are they going to get? So this should all be written into the operating agreement, because typically the LPs at the end of the day, without ever having read the operating agreement, are going to complain why they're not spoken to more often, why they're not getting certain details, why they're not sharing information with them. And if it's not in the operating agreement, there's nothing you can do. So make sure you know what you are in for in the operating agreement. Okay, so as we said, besides the LP and the GPs, there are other players in the capital stack, because in order to buy a property, you're putting in just a small percentage of the money. So there's got to be more people kicking in the rest of the money for you to buy that property. And they're going to have a say in the operating agreement as well. So you have your preferred equity investors. These people are a class above the regular limited partners. They will have certain returns promised to them. They come before the regular LPs, and this is done to fill out if you don't have enough money between your mortgage and your LPs and your GP. So you're going to go for a preferred equity investor, and you're going to have to obviously promise him more than the regular LPs are getting. He's going to come and look at the operating agreement and say, we got to make a couple of changes over here. They're going to want fixed returns. They're going to want capital return priority. They're going to want a lot of things that the LPs want, but they're going to just want more of it. They're also going to want limited control rights. They're going to say, they're going to demand more control. Again, everything that the LPs get, they want a little bit more of. And they're actually going to want one more thing. A limited partner is passive. These guys aren't so passive. What they're going to say is, we're giving you money and we trust you to run it, and that's great. And we only have limited control. But if things don't go well, we want the ability to come in and make them better and fix them up. So those are called cure rights. And then you would just write out all the things that can go wrong, certain thresholds that they fall below, where they get to step in, and what they're allowed to do, what their responsibilities become when they do step in. So if you still have preferred equity and limited partners and the GPs and the banks, which we'll get to in a minute for the mortgage, and there's still not enough money, sometimes you get a mezzanine lender. Now, it doesn't have to be in the beginning of the deal. It could be if you're running out of money and you need to take another loan. So mezzanine lenders will step in. They, in the capital stack, are after the bankers. The bankers are number one. They will never agree to give you money unless they are number one on whatever happens. But these mezzanine lenders will insist that after the banks, they're next online. And if any money comes out, it goes to them before it goes to any preferred equity, preferred investors, or limited partners or general partners. So what do they want? They're going to want, obviously, a fixed interest payment because they're actually giving a loan. They're not equity partners, they're lenders. They're going to want collateral. They're going to insist that even though the bank has full collateral on the loan, they're going to insist that they share in the collateral. They're going to want the property as collateral. They would want subordination where they are right after the bank. And they, of course, will want cure rights where they can come in and take control of the LLC if it's not meeting its targets. And finally, the bank. The bank is the most important player, the most important partner of every real estate transaction because they're giving the bulk of the money with the mortgage. So they are pretty tough. As you see, you'll have to grovel to the bank to get your money, and you'll have to abide by their terms. So they're the senior lenders, the senior most lenders. Nobody stands below them on the capital stack. They are where the buck stops. What do they want? They want first lien position. They are number one. Anything happens, they'll give you, if they give you 70% of the money, so as long as the property is still worth 70%, they're okay. They still have collateral, although it's not fun and it's not profitable for them to do that, but at least they have that. They're going to have a whole bunch of loan covenants and restrictions. They're going to tell you what you have to do with the money and what you can't do with the money, what you could do with your business and what you can't do with your business. And we'll dive into a little bit more detail in a minute. They're going to want control over any transfers or refinancing. So they are going to say, look, we're giving you guys the money and you guys can't bail out of this deal and give it to anybody else. If you want to give this deal over to somebody else or transfer, it's only with our approval. And the same with refinancing. You owe us money until you don't pay off our loan. Don't go ahead and start borrowing more money and over leverage the property until until you actually fail because you're trying to service your debt every month and then you go kaput. And they're going to want financial reporting and monitoring far greater. They call the shots and they have very detailed reporting and how they want it done. So let's look at some of the covenants and restrictions that the bank is going to ask for. These are the affirmative covenants. These are things that you must do. So the first thing they're going to do is make sure that you're a single purpose entity. This goes back to the purpose of the LLC. So until now, it may say we can do business in the state of Georgia, whatever we want to do, they're going to say no. You got to amend that and write that it's for this property and this property only. We're giving you money and we want to make sure that the money is not lost elsewhere. So they're going to insist on a single purpose entity. They're going to want the financial reporting, as we said. They're going to insist that you have insurance because they're not the insurance company. And if something happens to the property, because the property is their collateral, they're going to want to make sure that the money is in the bank, not in the bank, but it can be taken by the bank when insurance pays out. They're going to make sure that you maintain the property. Again, you're watching their collateral and they're going to make sure that it's done right. They may ask for a lockbox account, which means that the money that you make goes into account and it's locked and they have the keys. They release the money to you. You don't have full rights over the money anymore. I mean, when you do a bank loan, you can sometimes, depending on how restrictive it is, you are selling your soul to the bank, which again is not terrible because all they're doing is making sure that there's no foul play over here and everything is done by the book. And they're not counting on you. They're putting in safeguards to make sure it's done like that. And they may even assign the rents. They may ask you to assign the rents to them, which means that the contracts are assigned to them. So if you go bankrupt or something happens to you, then they have a contract directly with the tenants, and they can collect their money without too much hassle. And of course, they're going to want approval on any major decision. What are some of the no-nos that the bank does not want to see? They will say there's no additional debt without their permission. There's no sale of the property without their permission. Because if you're going to sell it for less than the money that you owe to them, that is not going to make them very happy. No ownership transfers, which we said. There's no distributions to equity holders until you meet certain thresholds. They want to make sure that the money you're making is available to pay your loans and not to give out to all the investors which means they may be left holding the bag next month or the month after. So they're going to tell you exactly how you can distribute to the equity holders and when you meet certain thresholds. There'll be limitations on the use of cash flow, and you can't use it for whatever you want, but there'll be certain things that are agreed upon that you're allowed to use the money for. And they'll have very restrictive financial ratios, and that means that you need to always make sure that your company is operating above these ratios in order for them to not foreclose, or if you break any of these covenants, there are things that they can do. They can foreclose on you. And it's not a situation you want to get yourself into. So I think, last one, prohibition of bankruptcy. You can't file bankruptcy. You can't take your property that they lent money to and go to bankruptcy court. They may get their money at the end from the bankruptcy court, but it's going to take a long time, and they probably won't get their full money back. So they can they can stop you from going to bankruptcy court. So I think we covered a lot of stuff. Just to recap, we discussed some of the key highlights and sections of the operating agreement and some of the things that you should look out for and some of the things that are typically in there. But again, it's free for you. You can do it in 1 page. You can do it in 100 pages. You don't have to write extra for the sake of it. Be realistic when you write your operating agreement. And then we discussed some of the things that whether you're an investor, whether you're a lender, whatever it is, that you should look out for in the operating agreement before getting into any deal, because that will help you. So that about wraps it up. If you have any questions, here are my details. We will have a recording. We do have a recording of it. So if anybody wants the recording, or if anybody wants the slides, the easiest way to reach me is to go to LinkedIn and just DM me, or you can use my email, or you can give me a call. I'm happy to answer any questions, discuss if something wasn't clear. I'm here for you. Lastly, just a little word about NUCO. What do we do essentially? Like I said, we're not lawyers. We don't do operating agreements. What we do is we help people form LLCs. We do state filings for them. We form the LLC. We do the BOI reports for them. We have a beautiful portal that's incredible to keep track. We know from experience that keeping track of your LLCs is sometimes real chaos. And unfortunately, we know that most people are not in compliance. So we keep you in compliance. And we're registered agents in all 50 states. So we can help you with that. We actually do all state filings, not just LLCs, and not just for real estate companies, but that's our primary focus. So if you have LLCs and you'd like us to babysit them for you or be a registered agent, or if you need to file your BOIs, which I soon do, I hope everybody's keeping track of the calendar, reach out to us and we're happy to help you. Thank you very much. Thanks for joining, everybody. I appreciate it, and have a great rest of the day.